Warren Buffett made his first investment at the age of 11. He bought 3 shares of a company called City Service for $38. The stock dropped almost immediately. He held on. It recovered. He sold, making a small profit. Then he watched it climb to $200 a share. He was 11 years old, and he had already learned the most important and most painful lesson in investing. Patience is not just a virtue. It is the mechanism. It is the actual engine of wealth. Most people think they understand. The Warren Buffett story. Self-made, frugal, patient, great at picking stocks. Every part of that is true, and every part of that completely misses what actually built one of the largest personal fortunes in human history. Today on Wealth Map, we are mapping the real Buffett machine, the specific mechanics that turned $11 of childhood savings into $130 billion, and the single most important number in his story that almost nobody ever talks about. Here is what most people get wrong about Warren Buffett. They think he is a stock picker. He is not a stock picker. He is an insurance company owner who has spent 60 years investing other people's money completely for free. Let us break this down because this is the foundation of everything. In 1967, Buffett's company, Berkshire Hathaway, acquired a small insurance company called National Indemnity. To most observers, this looked like a modest acquisition, a side investment. It was the most consequential financial decision he ever made. Here is how insurance works. A customer pays a premium today. The insurance company holds that money, sometimes for years, before it ever has to pay out a claim. During that time, the insurance company can invest the money freely. This pool of held premium money is called the float. Berkshire Hathaway's float in 1967 was approximately $17 million. Today, it exceeds $160 billion. $160 billion of other people's money that Buffett gets to invest at zero cost with zero interest. A permanent, self-replenishing source of investment capital that the vast majority of investors on Earth will never have access to. When analysts talk about Buffett's investment returns, they are almost always measuring the wrong thing. They look at which stocks he picked. They should be looking at the cost of the capital he used to buy them. Most investors borrow money to invest and pay interest. Buffett used insurance premiums and paid nothing. That structural advantage, compounded over 60 years, explains more of his wealth than any individual stock pick ever could. But there is a second layer to the Buffett machine that goes even deeper. Buffett did not just pick great companies. He specifically and deliberately picked companies that generated enormous amounts of cash, far more cash than they needed to operate, and then used that excess cash to acquire more great companies. Think of it as a perpetual motion machine. Berkshire acquires a cash-generating business. That business throws off hundreds of millions in free cash every year. Buffett takes that cash and acquires another cash-generating business. That business throws off more cash. The cycle repeats, year after year, decade after decade, with no external financing required. No bank loans, no share issuances diluting existing investors. The machine funds itself, and it has been running without interruption since the late 1960s. Charlie Munger, Buffett's longtime partner, once described the strategy simply. Find a wonderful business at a fair price, then do absolutely nothing. The doing nothing part is where most investors fail completely. Now here is the number that changes everything about how you think about wealth building. Warren Buffett is currently worth approximately $130 billion. He started investing seriously at around age 20 with roughly $10,000. Here is the fact that almost nobody in finance talks about clearly enough. 90% of Warren Buffett's net worth was accumulated after his 65th birthday. Read that again. After 65. At 60 years old, Buffett was worth approximately $3.8 billion. Remarkable by any measure, but $3.8 billion is less than 3% of his current wealth. The remaining 97% came from continuing to compound for another 30 years. This is the most important and most ignored lesson in the entire history of investing. The variable that matters most in wealth building is not how much you invest. It is not even the rate of return you achieve. It is how many years you allow compounding to run uninterrupted. Time is not one factor among many. Time is the primary factor. Everything else serves time. The Buffett story is not a story about a genius who saw things others could not see. It is a story about a man who understood one mathematical principle more deeply than almost anyone alive, and then built an entire financial machine designed to exploit that principle for as long as humanly possible. The float gave him free capital. The cash-generating businesses gave him perpetual reinvestment. And time, 70 years of uninterrupted compounding, did the rest. You will not replicate Buffett's scale. Almost no one will. But the principle at the core of his machine: start early. Use the cheapest capital available. Pick businesses that fund their own growth and never interrupt the compounding is available to anyone willing to apply it with the same patience he has shown for 7 decades. This is Wealth Map, where the mechanics behind the world's greatest wealth become visible. If this changed how you think about money, subscribe, because the next map reveals a financial system most people interact with every single day without ever understanding how it really works.